Redefining today is about our guest, who is Steve, a dad who thinks about the future. He says he's fairly normal in many ways, but does like to ask big questions. He is currently the head of impact at Paradigm Norton Financial Planning. He is interested in future trends in macroeconomics, plus has always been committed to action on climate change and inequality. Quite a hot topic with COP27 currently taking place in Egypt. So welcome to the Wellbeing Cafe, Steve. How are you today?
Thanks, Hiran. Yeah, I'm really well, and it's really great to be with you and to see some familiar faces as well.
Excellent. Well, I'll open for you and your presentation. By all means, as sort of Steve would welcome questions during the thing, feel free to put them in the chat. I'll put through or save them till the end when we should have a few minutes for it. So the floor is yours, Steve. Thank you.
Thank you. I'll share my screen to kick us off. And yeah, it's really great to be with you all. Thanks all for taking some time to be here. So there we go. Hopefully you can see that screen. It should be coming up.
We can. Thank you.
Great. So as Hiran said, I'm Steve. I think I'm speaking to you here today because I do like thinking about challenging questions. I've been thinking about some of these questions for quite a while. And I wrote a paper about 18 months ago trying to unpack some of them, really thinking about the future and future trends. And here I am to speak to you. Definitely not an expert, so please, I hope, I did hear someone use that word earlier, it's definitely not true, but someone who asks questions. So today, in this half hour, we're going to question what is perhaps the unquestionable. Some of this thinking is a little out of the box. You might possibly find it a bit challenging or uncomfortable. Apologies if so, that's not my intention, but that could happen. You also may not agree, and that's absolutely fine. Lots of my colleagues and my friends don't, and tell me so. There is probably evidence on both sides of the argument that I'm going to talk about, perhaps more evidence against what I say than for it. So I'm not asking you to believe this without questioning, but I am inviting you to ask big questions and to be open about the other possibilities and what that might mean. I think given the potentially far-reaching consequences, I really think these questions are worth asking. 20 minutes isn't very long, so this is going to be quite a fast-paced talk. I hope you can stay with me. As Hiran said, there will be chance for questions and discussion at the end, but if something isn't clear and you think it's necessary, then please do stop and ask me along the way. Hopefully it'll be clear. Okay, so our story today starts with a bottle of beer, and this is to help us think about thermodynamics and alcohol. Now, I studied engineering at university. As most people know, you probably shouldn't try to digest thermodynamics and alcohol at the same time, but we're going to have a go. So the laws of thermodynamics about energy in equaling energy out suggest that no closed system can sustain exponential growth forever. So as an example, during brewing beer, the yeast grows exponentially and the alcohol content steadily rises in the beer until the point at which the sugar is used up and converted into alcohol, equilibrium is reached, and the process stops. So why are we thinking about beer and exponential growth? Well, as we all know from Liz Truss saying it recently, growth is a big issue. The power of compound interest that has provided investment returns over the years is also obviously at work within the growth of the global economy, and the economy continues to grow. But within the global economic system, there are constraints. Our economy is underpinned by resources and land on Earth, which are both finite, and population growth, which is slowing. So let's take the fairly long view. Here's a graph reconstructing global GDP throughout the last 2,000 years of history. As you'll see, there's not much growth until the 18th century, when the Industrial Revolution then starts to kick in. So since then, humanity has sustained about 200 years of strong global economic growth. But that is a unique occurrence that is really without precedent in our history of humanity. So the question for us, the big question is, can this curve continue to increase towards infinity, perhaps forever? Or maybe a more relevant question, at least, can that growth be sustained over the lifetime of those who are alive today? So perhaps the next 100 years. World GDP has been growing at 3 to 4% annually. So if growth like that is sustained, then the world economy would double in around 20 years from now, which to me feels like a stretch. This is a long-term growth forecast issued by the OECD, and it was published in October, just over a year ago, October 2021. So this was actually before the Ukraine war or before inflation shocks had hit the global economy. Now, the OECD basically are the champions of growth. Their remit is to improve the global economy and promote world trade. So even they are quite pessimistic about the future. And as you'll see, they're predicting only what they call mediocre global growth, with the rate slowing until 2060. But there's a bit of a catch with this graph and this report they issued, which is that even to predict this relatively low level of growth, they've had to include some fairly significant assumptions. And one of their caveats, if you read the report, is they say this scenario omits some important factors, such as the environment. So basically behind this, they're assuming that carbon emissions would continue to increase. And a previous version of this report assumed that carbon emissions would double by 2060, which is, I think we'd probably agree, problematic. So if we've got some questions about exponential growth continuing, what's the alternative to ongoing growth? Well, the alternative is that growth slows and eventually stops. So this middle graph, the S curve of logistic growth, seems like it could be a more likely scenario, particularly as humanity approaches various social and environmental limits. And the declining growth rate that we've seen in developed countries may indicate that some of those economies are entering the top of their growth curve, so what's called secular stagnation. Arguably, the market crashes of 2000, 2008, and more recently could be interpreted as symptoms of that, signs of it happening. So if growth is slowing, then why? What are the limiting factors? Well, the idea of there being limits to growth has been widely debated and contested since it was proposed in the early 1970s in this report. And the graph in this report shows their prediction, which was that declining resources would limit industrial output and food production. Now, many have strongly challenged the idea that growth is limited and will stop. But recently, an analysis commissioned by a parliamentary group of MPs revisited this original research from the 1970s. And they say that they think the original model that was proposed back then, nearly 50 years ago, still has validity, and that, to quote their words, there is unsettling evidence that society is still following the standard run of the original study, in which overshoot leads to an eventual collapse of production and living standards. Now, there is also another limit to growth that wasn't considered in this 1970s model, and that is planetary boundaries. So these are 9 processes and systems defined by scientists in 2009 that are said to regulate the stability and resilience of the Earth system. The scientists say that 4 of these planetary boundaries have been breached. So if humanity is to stay safely within these planetary limits, then it seems to me this is likely to have significant implications for economic growth. We also, as humanity, urgently need to undertake an energy transition away from fossil fuels. The economic growth of the past 2 centuries has really only been possible due to the extraction of fossil fuels. The two have a very strong correlation, as you can see in this graph. So we have had essentially free, high-density energy. The depletion of this natural capital doesn't appear on any balance sheets of corporations or of governments. Now we need to change. Humanity has made other energy transitions in history, so it's not unprecedented to make an energy transition, but we've never made an energy transition from a high-density fuel to a lower-density energy source, or done it with such urgency. So we don't really know what will happen as a result of the shocks of this change that we need to undergo. But do we really have to change path from growth? Well, certainly economies are now so dependent on this growth that it is very difficult to imagine anything different. A lot of the critics have argued since the 1970s that the implications of abandoning growth would just be too significant, too costly, too risky to be countenanced. So therefore, the argument goes, since economic growth is basically seen as a necessity, a political, social, and financial necessity, the mainstream position is that green growth must be possible. So is green growth the solution? Is that the future that we can hope for? Well, to go back to my example at the start, it's certainly true that the Earth is not quite a closed system like a beer fermenter. We do have the sun, which is providing free light and energy to us on Earth. So could this be the solution to ongoing green growth? Advocates of green growth are often technology optimists, believing that innovation will provide the solutions and enable humanity to maintain a new wave of GDP growth while simultaneously reducing our carbon emissions. Now, this absolutely may prove to be true. New waves of technology have historically delivered growth that has really confounded expectations. And also, when we look at the developing economies around the world, some green growth may certainly still be possible while staying within planetary boundaries. Plus, there's also a lot of hope that the investment required in new green technology may stimulate economies and markets in the short to medium term and provide some growth. However, the reality, while this is all definitely worth further thought, the reality is it's basically unproven. The technologies we need don't all exist yet. And so at the moment, this faith in human innovation and technology to deliver ongoing growth still seems to me very optimistic. It certainly doesn't have a proven evidence base behind it. And so it's really faith rather than fact. There are also strong limiting factors. So in order to stay within safe planetary limits, then most economies will need to completely decouple their economic growth from the impact they have on planetary boundaries. Obviously, most urgently, greenhouse gas emissions. And this is illustrated here on this chart. So in high-income countries, our lifestyles currently take about 3 planet Earths of resources to sustain our lifestyles. And we can't just make changes so that resource use simply just grows less slowly than GDP grows, which is known as relative decoupling, that top black line. Even economies that have already achieved some absolute decoupling are not yet reducing their emissions sufficiently fast enough to go below the green line and stay within planetary boundaries. So is it feasible to get below the line, to decouple growth from resource use? Well, green growth advocates would say that the solution lies in a combination of renewable energy, resource-efficient circular economies, and the so-called weightless digital and knowledge economies, so powered by AI and requiring minimal resource use. And their hope is that this could deliver ongoing growth that's decoupled from resource use. Now, these ideas may have some validity. Human innovation, as I've said, is certainly a powerful thing. But remember, for GDP to continue to grow into the future, resource use would also have to continue to reduce. So decoupling from growth even more ad infinitum, continual reductions forever. And an OECD report said, and I think a bit of an understatement, we do not know, if we're honest, what impact this will have on long-term growth rates, but they still believe we can grow. So I'm just sort of emphasizing that the scale of the challenge here is really quite daunting. And even if possible, I think it could cause very significant stresses to the economic system. Certainly that's backed up by some research. One set of economic modeling suggests that a successful transition, while still holding to growth as we've had in the past, is highly uncertain, and they say would require actions that have only previously been seen in a wartime economy. Plus, unfortunately, carbon reductions on their own would not be sufficient. So scientists from the Climate Crisis Advisory Group, chaired by the former UK government chief scientist, warn that due to the lags in the climate system, we've already gone too far. even reducing carbon emissions to net zero will not now prevent catastrophic sea level rises that would result in many major cities, such as 15 million people in Calcutta, 11 million people in Jakarta, from being flooded by 2050. So those scientists say we need technology for mass removal of carbon from the atmosphere to get carbon levels back down to a safer level, such as it was in the 1980s. But even if we do that removal, still the submersion of major world cities would cause migration on a huge scale to relocate people to somewhere which isn't flooded. So the scientists say that in addition to removal, in order to avert widespread societal breakdown, perhaps in the worst case in the coming century, they believe we need repair. We need to develop technology for mass climate repair or restoration. So for example, that might mean things like weather technology to generate snow on the polar ice caps in the Himalayas. And this would have to obviously operate at immense scale in order to reduce sea levels in any meaningful way, and it would have to be net zero. Now, remarkably, the scientists say they're still optimistic that that can be done, but it just emphasizes, again, the scale of the challenge ahead of us. So to me, it seems clear that we're entering a really unprecedented period in human history. And it's a brave act of faith to believe that any historical economic patterns are going to hold true in this new era. So growth may not last forever. It may slow or stop in the future. If it did, how long have we actually got? When will this start to affect things? Is this 100 years' time, 50 years, or now? When does it start to impact our lives? Well, I think the answer could be now. Society may have reached a tipping point. It seems to me that financial shocks, which could be characteristic of growth slowing, are becoming regular. We may have passed peak growth, even if we're not quite post-growth yet. We know that climate shocks are becoming more frequent, and the UN this week at COP warning that the climate's really at the ultimate tipping point. We've got to undertake an urgent energy transition, and we're approaching planetary limits. So all of this may compound other risks in ways that could affect economies and markets in the short term now. And the financial system doesn't appear to have the resilience to withstand that. So the short-term risks, I think, are high, as we've perhaps seen this year with further turbulence in the UK and around the world. So let's have a think about the resilience of the financial system. So we learned in 2008 of the dangers of systemic stress to the financial system, the possibility that the house of cards could collapse. And while some lessons may have been learned, there are many complex risks that remain within the interconnected global system. So when we encounter the shocks, which are of increasing frequency that we're likely to encounter, the system may not have resilience to withstand them. Let's think about one example of that. If there are limits to growth, then that implies there's probably a limit on the investment that drives growth and consumption. However, money at the moment is not limited. We've given commercial banks the privilege of creating money. And then money created by banks as loans is channeled into activities like buying houses, land, stocks and shares. And these investments often do not create new wealth which could pay off the interest on the loans, but instead they often earn a return simply by pushing up the price of the existing assets. And so this growth and debt cycle leads to an ever increasing supply of money in the system. And the practice of quantitative easing since the 2008 financial crisis has pumped in even more money, inflating the price of commodities, property and bonds. And then in response to COVID, the G7 central banks expanded QE programs by $10 trillion. That's roughly half the size of the US economy. So as well as inflating asset prices, QE has then had other effects. It's encouraged corporations to carry out share buybacks financed by debt. And that's both increased corporate debt and inflated the share prices of those companies. COVID has obviously also hugely increased government debt around the world. So, I mean, to me, you really start to question whether the car is still driving or whether we're in one of those old films where everyone's frantically moving the background to make us believe that the car is still moving. But is it really still moving? We've certainly got some real challenges. We've got inflated asset prices, high personal debt, high corporate debt, high government debt. This hasn't felt very resilient to me when I've looked at it, and perhaps the UK started to find that. It certainly increases the risk that in the face of whatever stresses and shocks come, caused by the need to decouple growth from resource use, economies and markets may suffer even greater losses, and the global economy may have less resilience to enable a swift recovery from whatever dips have come. So I've discussed with you some of maybe the primary drivers of change in the future. Alongside this, here are some key risks I see. And I wrote this list of risks, about 18 months ago in the midst of the pandemic when I wrote a paper about this. And sadly, since then, we've ticked off at least the next two, I think, on the list with the Ukraine crisis and inflation. Sovereign debt now is looking increasingly problematic for many countries, particularly emerging economies, and Europe perhaps as well. And these could obviously provide the triggers that cause a systemic crisis. I've felt for some time, and I continue to believe that unfortunately in the short term, there could be a shock, perhaps of unprecedented levels, from which the economy finds it really hard to recover. It's pretty clear now that we're heading into a difficult recession. I suspect that will be deeper and longer than we expect, probably a serious extended crisis, perhaps measured in decades, not months or years. So, I'm sorry if this is depressing, but I do believe we're living through a major change, which I think in time may ultimately prove to lead to a realignment of the global order. But it's not the end of the world, as one of my colleagues jokes for me. But it probably does mean that the world could look quite different. So it might be the end of the world as we've known it. But that perhaps may not entirely be a bad thing. But my point is, fundamental things are changing, and it could mean that historical patterns may not hold in future. So, to come to the topic of the talk, what does this mean for us? This is all a challenge. When we advise clients, as I imagine most of you do, we rely on historical evidence about long-term investing. But what if this is a new era? What if those patterns may not hold true in future? What might that mean for people who have pensions and investments? What are the implications for advisors who help people to plan for the future? We certainly know there's more uncertainty than ever. And I mean, let's hope that the historical patterns do prove true, but I think we have to consider the other possibilities, especially as it could invalidate some of the advice that's given and have significant implications for clients, as well as, frankly, for the business models of advisors as well. So I think there are some things we can consider to increase resilience in the short term. First of all, future growth. Advisors may have underestimated the risks and overestimated the returns associated with particularly equity investments. Secondly, preparing for shocks. I think it's possible that defensive asset classes could fail to offer sufficient protection from market shocks in some conceivable circumstances. Again, I wrote that 18 months ago before some of what we've seen recently happened. Plus, as advisors, business models often offer very little protection from market shocks, particularly if there's a slow recovery. So for clients, but also for your businesses, diversification seems important. Diversifying income for clients, but perhaps also revenue for your business. And finally, it may be necessary to redefine what it means to be an investor. We may have been reinforcing the assumption that investors can expect returns from infinite growth on a finite planet. So what does it mean to be an investor who's contributing to the regenerative economy of the future? Well, you may be familiar with the concept of the donut. It basically is illustrating the Goldilocks idea, not falling short of basic living standards, but also not overshooting environmental limits. So what does it look like to apply donut economics and this model of the donut to investing? Well, it can't mean unsustainable returns based on an extractive economy. And I think it has to mean playing a part in a regenerative economy. Now, researchers have started to say that it could be possible to make the transition to a post-growth economy. Certainly humanity for most of history seems to have managed without growth, so why can't we make that transition? In the future, I mean, there are very likely to be profitable companies who align strong social and environmental purpose with a profitable business model. These companies are going to need investment, and they could well pay dividends on profits. Perhaps corporations are more likely to deliver income than stock price growth in future. That's a possibility. Stock markets in the past have usually been powered by the success of a few standout companies. And so, as has been the case in the past, it may be that a small minority of companies may well grow significantly, primarily by delivering the transition that humanity needs. But there is a challenge here, which is that markets, I think, are broken. There's no real mechanism or data for markets to reliably price in some of this information. However, there is probably enough information available to enable us to align our investments and our strategies with what we know are the challenges and needs of humanity in this new era, allocating capital so that it works towards the future. So broadly, we can think of corporations in three categories. This isn't my idea, credit to Webb for this, I think. Businesses at risk, transitioning, and sustainable. Businesses at risk, their revenue is really linked to carbon emissions. It's a big challenge for them. Many companies are now transitioning, and then there is a tension in investing in these transitioning companies. As much as we want to encourage the transition that they're making, their business models basically rely on encouraging more consumption, which the planet can't afford. So a sustainable path, I think, means investing in companies that don't encourage more consumption. So we're looking for those companies where sales are linked to impact, rather than sales and revenue being directly linked to consumption. Now, if we're looking for companies that deliver long-term income and growth in a possibly post-growth or lowering growth scenario, then you can make your own judgment about which group of companies you think are most likely to belong, the growing companies of the future, or the ones delivering returns are most likely to be in. So, coming into land, a couple of minutes over time, sorry, Hiram. What does it mean to be an investor for the future? Well, as you might have guessed, I haven't got all the answers. Apologies if you'd hoped I had. And I'd really welcome your ideas as well. But perhaps here's some clues towards what a hopeful future path may be. I think it means being less growth focused, delinking from consumption. Secondly, circularity is a buzzword you've probably already heard a lot of. It's going to be very important, looking for economies where it's based on efficiency, not extraction. I think a less debt-dependent economy, particularly as we, I think, imagine it might be a pretty bumpy ride ahead. Individuals, companies, governments need to be able to withstand shocks, and I expect we'll see pretty extreme volatility in the future as it's started to become more normal. Then, I love this phrase, the art of enough. Breaking the cycle of scarcity and excess, and breaking that cycle by starting with our mindset, with how we think. So Becky Hall writes about this in her book, The Art of Enough. I really recommend that. And one aspect of it is probably more modest and sustainable standards of living that we expect. Then I've mentioned donut economy already, and looking for that in terms of investment, looking for companies that deliver impact, looking for social and environmental returns when we invest. And lastly, engagement. I think as investors, being much more engaged in what is being done with our money, being actively engaged, or perhaps, dare I say, even activist investors, not just active investors. And so, to sum up, maybe as the small beer company, I thought we'd finish with beer as we started with beer. The small beer company has shown with their lower alcohol beers and drinks that perhaps with less or even no growth in our economic brew, if you like, we could still deliver plenty of well-being. So there you go. It's quite a lot to throw at you for a lunchtime. It may feel a bit much to take in. I understand that. take a breath if that's the case. As I've said, you don't have to agree. I may be wrong. If you've got time to stick around, I'd love to hear your thoughts and the questions this raises for you. And my contact details are there. If after reflecting you'd like to get in touch, please do. I think I mentioned I wrote a paper about this. I think Judy has a copy of that and would be happy to share that if people are interested as well. Thank you very much.
Excellent. Thank you so much, Steve. I love it being a Wellbeing cafe. You can bring tea, coffee, or stronger, and you brought the stronger. So I like the beer. So I would like to open up for any questions. Feel free to unmute yourselves from sort of Steve's presentation. And while I look around to see if anybody's got any hands up, Yogesh has unmuted. Is there a question?
Yeah. Just wanted to, obviously, I did a remote clapping hand. Steve, well done. That was excellent what you presented. And I put something on there. I'm just talking about the GDP. This started about 70 years ago, and it's about measuring it. Why do we still need the same criteria for measuring GDP? We need to think about redesigning the world. There's an excellent book I'm reading at the moment by Sam Pitroda, who was stuck in Chicago during the COVID, and he's written a book about redesigning the world. And he says in his book that the earth does not belong to man, that man belongs to the earth, and that all things are sort of connected like the blood that unites one family. And I think having read, I'm almost at the end of the book, that a new global conversation to help find new solutions to redesign the world with a focus on planet and people, I think are all about the well-being. There's a lot of excess around, and it's about redistribution, that excess. So I think that's where my thoughts are in terms of where we go. By the way, it was lovely to see Ruth and Chris both at the festival. I think, Ruth, we had a chat. Thought it was an excellent festival. So those are my comments. And once again, thank you, Steve.
Thanks, Yogesh. I believe we have a question from Chris. Feel free to unmute. In the interest of time, I'm just conscious that people have allocated a few minutes, but feel free to continue joining us if you can. Chris.
Thanks, Aaron. Thanks, Steve. I've read your paper, and I think I completely agree with your theory. I am on your side. The question that it leads to for financial planners is, when you are creating cash flow forecasts, when you're talking to client about future growth, when you're creating investments, is what changes does this mean to how people go approach that process?
Would anyone else like to respond before I do?
I'm expecting you'd have all the answers, by the way.
Yeah, bad luck, Chris. Bad luck.
As you not being the expert in the room, Steve, I'll let you start.
Thanks, Aaron. Chuck me in the deep end. Yeah, I mean, it's a challenge, isn't it? And I mean, as I say, I think the starting point has to be that we've always known there was uncertainty. We've always known that when we do cash flow planning. I think that just emphasizes that even more. I do think it could have implications for the kind of assumptions that are made in long-term cash flow plans. And I'm not the expert there to speak to that. I would defer to probably many of you and others who really are. But I think, part of my purpose in raising these questions is because, well, these are the kind of timescales that we think about when we work with clients. And so, I don't think it's good enough just to hope it continues and that next year's as good as this year and so on. I don't have the answer to exactly what that means, but I think it probably has to mean that we do have some different forecasts and there's perhaps some more conservative outlooks in there. I do think it also might change the conversation in terms of volatility. As I said, we could be looking at unprecedented falls in markets, perhaps. And so I think that may need to be mentioned. It could mean that, the real nightmare scenario is that there's big falls, but then there's not the kind of recovery that we've been used to seeing in previous. That really is the nightmare, not just for clients, but as I said, that's a real challenge for business models as well. Thanks for that.
I think that's probably quite an apt, and especially when we're talking to clients, in most conversations I find having is that we have been here before, but then we may not have, if that's what the question is. But I see Ruth's got a hand up. Ruth, feel free to unmute. Thank you. And then Richard, you'll be next.
Yeah, to be perfectly honest, I don't know that I've got anything particularly positive to add. In my very noddy brain that doesn't really understand economics, and maybe ultimately nobody does. I kind of have this sense that there's going to be this deflation point and we're all going to come down together. But I suspect that that's when there is the squabbling really starts. And, it would be an optimistic dream to think that we could have gradual deflation of asset prices over time. But, I think I probably share your more pessimistic outlook, Steve. And I think therefore it is a real challenge, isn't it? Because the very thing that we have built our businesses on and build our clients' future, and indeed our own futures on, is at risk. And these are challenging conversations, I think, to actually have with clients. But perhaps that's the direction of travel that we need to be taking.
Thank you, Ruth. Richard, just to sort of end on that question with Simon. I think I can unmute. Sorry.
There we go. Yeah, I'm struggling to actually articulate what I wanted to say, really. I mean, I've for a long time kind of been worried about, I always feel like in financial markets are so sentiment led, that particularly with interest rates rising and it's now easier to get a return without being in the market. Is that going to be another factor that's pushing us in that negative direction? Just simply, even if companies stay, say, as profitable as they've ever been, if more people have got a motivation to have their money in the bank instead of in companies, that's not even a change to the underlying fundamentals. It would potentially could it have an impact on pushing us in the wrong direction? But equally at the same, so I've got all these little muddled thoughts going around in my head. I mean, I think probably most of the people on this call probably aren't assuming 10% a year growth anyway. And one thing I thought was quite interesting, what you said, Steve, was that it might be we don't see as much growth, but we see more actual income being produced. It just seems that I'm really struggling to articulate what I want to say, but there's all these different narratives going on. And, if interest rates are higher and it costs more to borrow money, but there's no growth to be had in investing it, will it change? Is it another thing that will change the global order? Who would borrow to invest in businesses when the cost is higher, the potential results are looking worse? It wasn't even a question, was it? But I'm just interested to know, Steve, what you think about all those different things and how they play into it all.
I've got no doubt we can find a way through as humanity. We always have. I just think the future could look very different to the past. And so, I think these are the right kind of questions. But I don't want to be all doom and gloom, because I'm actually quite hopeful as well. And we're going to need that, aren't we? But human ingenuity is an amazing thing. But yeah, it's certainly going to be different.
Yeah, and on that positive note, Gary has obviously also commented that there's even more of a reason to work with a financial planner who's discussing these things with clients and a sort of financial coaches. So it's a good sort of, we are at the forefront of sort of ensuring that we're asking those questions and bringing it to highlight the risks to clients. So it's a great topic for today. I really appreciate the insights you've had. And as being a Wellbeing Cafe, one question I really would always like to ask our guests is, Steve, what do you do for your own well-being?
Yeah, great question. I've been doing some running recently. I've discovered that again. So I actually managed to run a bit faster than I ever have in the past. I love getting out to the countryside. I live in a city, so for me, getting out is great. Dare I say, occasionally a few minutes away from my children is quite good for my well-being. And
Excellent.
yeah, that's a little flavour of some of the things. There's been a hint to sort of, I mentioned alcohol once or twice, so that's probably good friends and a drink.
As a father pro, I can almost empathize with that. So thank you so much to get a round of applause for Steve. Thank you all for joining me. And as you mentioned as well, this will be shared in the sort of our group, as well as the paper that Steve referred to, which was written in June 21. You may see hints of bread dough as opposed to beer, but I prefer the beer analogy in terms of yeast. So thank you all, and look forward to seeing you in December on the 6th. Have a great week, month, and see you soon. Thank you.